Okay, so let's get into it. You've been staring at this a little while, but let's go through. We're talking about securities. By that I mean publicly traded securities. You can go, and there are various types of assets. There's equities, which we all know about here in San Francisco, that you can trade, represents the value of the company. There's credit, which represents debt that you're loaning money to either a company or a government. There's FX, foreign exchange, which is things like dollars to euro, yen to dollars, etc., where you can trade. And then there's commodities, crude oil, wheat, corn, hogs, cattle, cotton, etc., which are physical sort of commodities, physical things that you can actually have delivered to you. So some basic types of derivatives are futures. Futures are basically, futures have a price and a date to them. Like you can buy November crude oil, and that means that if you have that contract in November 20th something, there's going to be some oil that shows up to Cushing, Oklahoma with your name on it. So that's there. You had to get out before then, but it's legitimately used by companies to hedge their risk, right? So if you're a company, if you're a farmer and you got a bunch of corn that you want to plant, well, you'd rather know how much revenue you're going to get off that corn before you go and buy the new tractor. So you are basically offloading this risk. It's a risk transfer, and speculators are in the market to sort of take on that risk so the farmer doesn't need to. And the farmer, he's going to try to time it, but he's not that interested in making money off the trade. He just wants the certainty of it. Options are the right but not the obligation to buy or sell a security at a particular price at a particular date. The main thing about them is they have asymmetric payouts. You buy an option, you spend a small amount of premium, and that's the most you can lose in that bet. And if the underlying security moves in your favor, eventually you'll start making money. But you're basically fixed loss, and then like that. So that's there's leverage. So you want to buy $2 worth of stuff, but you only have $1 of cash. There's explicit leverage where you go to a bank and you borrow money and you use that money to actually buy securities, and there's implicit leverage for futures and options. Like if I buy $100 of gold, I only need to put down like $10 of cash margin to have $100 of value. So you can lever futures, and options are also implicitly levered. Capacity is just how much assets can you trade before you move the market too much that you no longer make money. And then just BIP is just 100 bips equal percent. So I'll talk about anything like sub 1%. You just say, oh, 50 bips kind of thing. Anyways, let's define the problem. What do sophisticated investors care about? It's returns relative to risk, correlation to their existing portfolio, and reasons why the strategy works, or trying to understand the underlying risks. So this is all about returns. If you tell me a return, it means nothing to me. I need to know a return relative to some risk you take. As mentioning about leverage, you can always lever up and make more returns. The question is, what was your ratio of return to risk? And there's various measures of risk. There's the Sharpe ratio, which is the most common. And on the top, what you have is the annual return of the portfolio minus the risk-free rate, which is commonly sort of short-term treasuries, what you could earn with with effectively no risk, divided by the standard deviation. Another way to look at this is and usually we talk about annual Sharpes, so annual returns, annual volatility. But another way to look at this is if you use daily data, you have the average return, daily return, the daily volatility, and you're multiplying it by the square root of 252, which is the number of trading days in a year. So you're effectively calculating a standard error away from the risk-free rate with your data set, assuming a 1 year of data. So that's a good way to think about it. So Sortino ratio is the same numerator, but the denominator is downside risk, and what you do there is you look at the standard deviation of only the negatives, or below a certain rate. And you don't take the standard deviation of that, because then the average would be over here. You take it from 0 or the reference rate and do the mean sum squared. Return over max drawdown, that's not really an acronym people use, but it's pretty self-explanatory. You want return versus drawdown, and drawdowns are important because there's path dependency. If your investor outside money has to go through sort of a 20% loss, they're going to pull their money, and it doesn't matter if you make money after that. So people care about drawdowns. but it's hard to sort of optimize that. So there's beta and alpha. Beta is commonly used to describe systemic risk in the market. It is traditionally used to represent things like equity indices and bond indices and sort of a collection that's easily replicatable. And the point is that you don't need to pay a hedge fund to get equity exposure, to get to get returns from the equity world. So we want to take that out. We want to if it's all about what's their sandbox that they play in, right? When you're trying to choose what to do the beta to, right? So this is your returns. This is some other thing, and so let's say you're a tech. You decide to go sort of tech equities. Then you're going to compare it to this sort of tech subsector, right? Because getting into technology isn't an active decision that you're going to keep making. You happen to know tech, so you shouldn't get credit for being there. If all tech goes up, you shouldn't get credit for that. So you try to take out sort of that sort of risk, and then what you have left after you get through that is alpha, which is what people care about and want. Because it's uncorrelated by sort of definition. And beta has come to mean more things, such as various easily replicatable strategies. But I mean, alpha is can always be considered beta risk you don't know about kind of thing. But it's like the major factors that you can easily invest in, you don't need a hedge fund for. So this is the information ratio. It's just it's like the Sharpe ratio, but using alpha. And interesting thing about that is it goes like the square root of number of total decisions. If you're talking about annual IR, you want to know how many total independent decisions you made in a year. And that's the key word, independent. And so the more decisions you can make, the higher your information ratio is going to be, which is why HFT has been so successful. They're not much better at sort of being right. They just have hundreds of thousands of decisions every single year. So on an annual basis, they do absurdly well. So you got to separate out alpha and beta. It helps you assess skill levels. If you compare it to sort of the exposure you have to the index, and investors, they have beta themselves, so they want to manage that risk. And don't pay fees. You don't pay fees for beta. Go to Vanguard, pay 2 bips, you're good. Uncorrelated returns, so typically you have to realize that when you make a strategy, a quant strategy, you're not the final product, right? You're just a small piece of a massive portfolio that your investor has. And typically, we're talking about institutional investors like endowments, foundations, insurance companies, and those people are going to have 80 to 90% of the risk in just equity and credit indices. And you're representing sort of a portion of the remaining risk. So you have to think about in terms, this is why we want alpha, because you have to sort of diversify, you can diversify away, right? So if you add returns, they add linearly, it's just an addition. But risk doesn't do that. Risk adds like this, which is basically the law of cosine for triangles. You can always think of risk as a triangle. Like here's one risk, here's another, and the other side is the total risk. So if you have zero correlation, you're talking about a right angle. Positive correlation, you're talking about sort of obtuse, and then that. And so this is interesting right here. This is like if you take a subcomponent of the total portfolio and look at the Sharpe ratio and compare it to the total Sharpe ratio, as long as that's greater than the correlation of that subcomponent to the portfolio, adding it is going to be helpful. So you keep adding it, which means if you keep adding, then these things are going to become more correlated, and at some point you don't want to add anymore. But so that's the idea. Like if you can do something that's zero, correlation of zero or even negative correlations, you don't actually need that much return because to them it's great. They're going to put you in everyone else, and your risk is just going to disappear, in the diversification. Capacity versus information ratio. This is the formula from before. The main thing here is there's a trade-off. The faster you trade, the more decisions you make, but the faster you trade, the less volume there is to trade, and the more slippage starts to matter, because if your holding period is short, your expected volatility of that trade is a small number. So that constant sort of slippage is going to eat at your returns a lot more. So this is a basic sort of trade-off. So investors want to know why it works. Like, what is the risk? And there are various risks you can take. If you're investing in sort of small caps, a lot of large institutional investors aren't going to want to sort of own those, and so by owning them, you're actually owning some liquidity risk. If you're selling options, say you're selling way out of the money options, you're going to constantly make a little bit of money, but when the tail event happens, you're going to be wiped out. Like you're taking tail risk. And there's various other types of risk. It's just a matter of sort of understanding why your strategy works and what you're actually doing. So types of quant strategies can be sort of broken down to two different types. You have fundamentals trading, which is based on the actual information of the underlying security. So for commodities, you care about stocks to use. How much oil do we have in tanks versus how much oil are we going to use this year? Obviously, when supply is lower, when supply gets lower, price goes up, so you have an inverse relationship. Equities care about various measures of health for a company. Corporate bonds are the same, but it's all about defaulting, because you'll make the same interest rate until it defaults, and then you'll lose some portion of your money. And government bonds, sort of talks about the individual country and sort of its characteristics. And then there's technical strategies, which tries to know nothing about the actual security and just looks at price, volume, and open interest as signals. So types of fundamental strategies, you have sort of the more common sort of equity factor models. You take the things that are good for companies, and you subtract out the things that are bad for companies. You rank all the companies. You buy the top. You sell the bottom, right? That's a very sort of popular sort of thing to do. And then there's event-driven. So there's all kinds of reports out there that come out on some basis, on some regularity. There's economic reports. So if you can predict the employment report, if you can predict inflation, if you can predict GDP, those are easily traded and pretty straightforward to trade if your estimates are better than the market's estimate, right? It's all relative to what the market thinks. There's company news, earnings. A lot of hedge funds are trying to hit earnings. They're trying to figure out how much earnings is going to happen, and you can do real well there. There's macroeconomic, Fed banks, elections, and then commodities have a bunch of sort of weekly reports for oil and natural gas, and there's also the monthly World Agricultural Supply and Demand, or WASD. That's every month, but it only really matters in the summer when there's crops in the ground, and a little bit in the winter because of the southern hemisphere, or our winter. So two basic types of technical strategies are momentum, three, there's definitely three there. Momentum, mean reversion, and microstructure. So momentum is just the idea that if a price moves in a certain direction, it's going to continue to move in that direction. And there's sort of trading psychology that say it's going up. All the people who bought along the way, they're feeling great about life. They're up, they have profit, and if it comes down a little bit, they're not very worried. It's a logical fallacy, but that's sort of how we work. So that's the idea that once things start to move, they have a tendency to keep moving. And then there's so the interesting thing about that is you're not going to win as often, but you're going to have a much higher sort of reward to risk ratio. Like when you're right, you're going to make a lot more money than you lose when you're wrong, but you're not going to be right nearly as much. And then mean reversion is the opposite. You say, hey, there's something I expect to happen. If it moves away from that, it should come back into it. And it uses price averages and volatilities. Loose, if any, stops at all, and small targets. So mean reversion has a very high hit rate, but you generally lose more money when you're wrong than you make when you're right. And there's microstructure, HFT. It uses sort of the bid-ask price volume information in the market. So challenges with modeling markets. I mean, like all data, financial data are error-prone. Perhaps it's a little bit worse than in other areas, especially if you go to the higher frequency data sets. You have to, a lot of work goes into cleaning the data and making sure it's correct, because a lot of these machine learning techniques, just one single mislabeled example can totally mess up the model. Like if you're doing any sort of adaptive boosting, the model will just try really, really hard to fit that one outlier at the expense of everything else. There's also the fact it's changing constantly. It's not randomly changing, it's adaptive, it's adapting. So anything that works, money goes into it, right? And then there's too much money in it, and it stops working, and then money leaves. Sometimes the strategy works again. So there's this sort of natural sort of cat and mouse game going on. And if you're developing strategies, you have to be constantly thinking of what's next, because every strategy is going to die at some point. Because people are smart, and they're going to figure it out. Because of this, only a subset of the data is relevant. Typically you think about the most recent data being the most relevant. Because basically, if you tell me something happened 10 years ago in the markets, I don't care. Like, the markets are totally different today than they were 10 years ago. The participants are different, the methods are different, the sort of various participation. There was an interesting thing after the '08 crisis where if you didn't have stops, if you had a strategy that didn't have stops, you lost a lot of money on the downturn, and you probably went out of business or at least got scared about stops. And so post '08, everyone started using stops in the market, and it became very choppy in the sense that it would just go, it wouldn't ever sort of have long-term price movements because everyone was so cautious about losing money. So it changed the dynamics of the market. And that's pretty much, it's come back to more normal, but that's things like that happen. Signal to noise is really small. If you can win 55% of the time and get paid even, you make a viable strategy. You can win with that. If you take 10 securities and simulate uncorrelated, normally distributed returns, which of course never happens, you only need a signal to price correlation of 0.03. So we're talking R squared of 0.0009. This is a tiny signal, right? And most machine learning, artificial intelligence techniques do not excel in this sort of environment, especially when you have the fact that there are fat tails, not normally distributed, and rare events. And so you have weak signal and fat tails, and that means you have to be very cautious about overfitting the rare events, the tails, at the expense of everything else. And you can do that with just some different loss functions. Works well. Like there's the pseudo-Huber loss, which basically is linear after some time, but quadratic in the beginning. So that de-emphasizes sort of big errors. And then you have to survive, rare events that happen. Here's a very interesting one. So second week, August 2007, all these quant equity factor sort of hedge funds, they basically started having massive losses, like 6, 7, 8 standard deviation type of losses for them. And when you looked at the actual underlying factors, everything was going backwards. If the company had good free cash flow to debt ratio, which is a good thing, the company was going down. If the company had a lot of debt, which is not good, the price was going up. So everything started going backwards. And it took people a little while to figure out what was going on. And then on Friday, it all bounced back. So what happened? It was the canary and the subprime coal mine. All these multi-strats had subprime exposure. The market was starting to show cracks. They got margin called. They couldn't sell the subprime because there was no liquid market to do so. They had to raise money because they were getting margin called. And if they didn't raise the money, the broker would just liquidate their portfolio and would not really care about the execution price in that scenario. So they went to all their sort of liquid funds, which is quant equity is one of the more liquid sort of strategies. You need a lot of gross exposure to get risk, and you're dealing with stocks, which are generally pretty liquid. So they basically were ordered to get to de-risk. So they all just got out of their positions to pay the margin, and then that created a cascade effect, right? Every other quant fund started taking losses, so they got out, and the next quant fund, and it just became this vicious cycle. And then Friday, it all bounced back. So you might be saying, oh, what's the big deal? It bounced back. But like I said, when you have outside money, there's path dependency. I actually knew a guy. He was a quant manager. He'd been going about 2.5, 3 years at that point. I really liked him. I thought he was a good hedge fund. And on Thursday of that week, his major investor, his anchor investor, called him and said, get out of everything. And he sat there and tried to explain to them what was going on because we had sort of figured it out by that point, and was saying, listen, like this is just a weird dislocation, like it will come back. And the investor was like, I don't care, get out. So he went out of business because of that. So the point is that no data could have predicted this. There is no historical analogy to the situation exactly. I mean, you're dealing with sort of some unique events, which extremely high leverage was in the market. Like absurdly high leverage was being used in the market. I was actually, I started work at a fund of funds hedge fund after the financial crisis, and we had underlying hedge funds who were all levered, right? And the fund of funds itself had taken out a loan to be levered, and then investors into the fund of funds also had taken out loans to be levered. So it's three layers of leverage in the system. And so all these hedge funds gated, they wouldn't let you take your money out. And so everyone knew it was like sort of scrambling for cash. And basically like a lot of those companies that provided that leverage stopped doing that. So there's always things that had never happened before that came together, and you had to sort of try to figure out what was going on to understand it. So what can you do with that? It's a hard situation. One thing is always have type stops that things go against you, you just get out, and have liquid securities, you can get out. Others use unique inputs. Like the big problem was that every single quant fundamental equity fund were using the exact same metrics. And so when they started losing, everyone started losing. Yeah, so if you can understand the performance of the model, you have a small chance of being able to predict like when things are going to break and why they will break, and to give you a little more confidence to override the model when the conditions are just not conducive to what you're doing. Common oversights that I see in a lot of sort of academic papers is underestimating trading cost, and then what's called picking up pennies in front of the steamroller, and then not understanding the actual risk. So slippage is very important, especially if you have shorter holding periods, right? The shorter your holding period, the larger percentage slippage matters. You can generally model slippage with some factor you fit to, the volatility of the security, the participation rate, which is the percentage of volume during that period that you want to use or do use, to some exponent, typically between 1.5 and 2, and then some small constant. So with sort of middle of the range, 10x volume means 50x slippage. And so this is something you have to really worry about if you're a short-term trader, and a lot of people underestimate it, especially when you consider there's also commissions that go to brokers, and derivatives like options and futures can cost quite a bit to trade, especially if you're a smaller fund. And then rebates, exchanges will pay you for putting up bids and asks in order to encourage liquidity. And then cost to borrow. When you short a stock, you go to your broker, and the broker has another customer that's long the stock. You borrow that stock and sell it to the market, right? You have to pay interest for that to be able to do that. Picking up pennies in front of a steamroller. It's when you have a thing that works almost at a very high rate, but when it doesn't work, it wipes you out. There are things, we were invested in this one hedge fund that did bridge loan financing for Scottish real estate, which was great when the banks were lending because he has collected his 2% interest every single month. But then when the crisis hit, no more banks were lending, and he basically lost a ton of money in that process. And so if you just used the returns, you would have said, oh, this guy's really low risk, but he actually had this huge risk sitting there waiting to happen. Yeah, so it's hard to have data sometimes that capture these events. And not understanding actual risk. This is a true story. It happened a week or two ago. This young quant analyst came and was like, hey, I found this great strategy in gold counter spreads, and I'm sort of the resident expert on commodity counter spreads. So they forwarded it to me. And this guy, first he claimed it was riskless, which obviously is the first big red flag. Yeah. And that, he had the theoretical idea of like why the prices would converge. And I told him this at some point. I was like, it's like you're saying there's a huge mound of cash in a mall, and everyone's just walking by it, and you found it. This is a very liquid market. A lot of traders are trading this product. Unlikely you found something like this. But it showed great profitability over a very long look-back period, so he was convinced. Well, gold counter spreads are driven by interest rates. Interest rates have been going down, but it's very hard for them to go below zero. So this guy was basing his strategy on a risk which historically had worked, But given this, the closer you get to the zero bound, the less symmetric your sort of returns become. There has been negative interest rates for some government bonds during times of complete stress, which is weird because you're paying someone else to loan them money. But it's happened briefly a few times. Yeah, so fooled by randomness. As I said, return data can be misleading. Investors want to understand why. And most of them probably don't know the word, but they are Bayesians at heart. And here's a little story that was actually from the book Fooled by Randomness by Nassim Taleb. Is like, okay, you get an email on Sunday and it tells you market's going up, it goes up. That happens 9 more times in a row. You're like, wow, this guy, 10 coin flips in a row he got right. Like that's 1 out of 1,024 chance. This guy's good. You invest, doesn't go so well. Well, what happened was you weren't the only person he emailed. He emailed 10,000 people. 5,000 he said going up, 5,000 he said going down. Whoever was right, he kept emailing up, down, split, 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 right? And so totally randomly, he could have people that had been right 10 times in a row. And this is a bit of a contrived example, but there's some very real examples that aren't too far away from this. Pre-presidential election this year, there was this one random stats guy who was predicting 99-something% certainty of the election. And there was Nate Silver who was saying, it's more like 65%. And I got like an arguments over this. First of all, the 99% guy had a very obvious flaw in his methodology. But the other point was there's only one Nate Silver, and there's tens of thousands, if not more, of random stats guys. So it's very likely that one of them will have lucked out during that process. And so it's hard to compare that. And they also were using different metrics. In 2012, they used one metric. It was bad. And obviously, that guy was an idiot. Sorry, that's going public, huh? Yeah, so there's the typical steps where you're trying to make a strategy. You start with trying to get a signal, some sort of correlation of prices, or some sort of series of events that you would like to happen before you expect you can predict the price. Once you have that, you need to allocate the risk across securities in an intelligent manner to create and there's 2 ways to do it. A lot of traders do what I call a collection of trades. They're not actually thinking about their portfolio. They have sort of a series of trades they like and they put it in there and they don't really think about it. And there's, I think, the better way to go, which is the portfolio level, where you actually look at the correlations, the covariance matrix, and optimize for that. And at the end, you throw in some portfolio level risk management, like size of positions, total gross, total net, etc. So here's some methods used for generating signals. First, a method I really like is called bagging. Bootstrap aggregating, and this is a meta sort of technique, so you can use it with any underlying model. And it's just you train the model or you optimize the model several times with random data points, right? So you don't give it all the data, you give it a subset of the data randomly. You do that many times, you average the results, and it turns out this decreases the variance without increasing the bias. So it's very useful, and there's also features bagging where instead of a subset of the data points, you're using a subset of the variables, the columns in your data. And I mainly use this to use a shorter look back period because like I said, there's not that much relevant data. And if you have to look back far in time, you're not, it's not a very good indicator. So this is a great way to sort of shorten your look back period. Quick aside, principal component analysis. I'm a big fan of these as well, although but the idea is that you find a linear combination of securities. If you have a bunch of securities, you find linear combinations that are independent to one another, right? And so you can sort of change the variables to make it. And the first component explains the most of the risk, and the last component, the smallest eigenvalue, explains the least of the risk. It's the same thing as finding eigenvectors of the covariance matrix. Intuitively, though, you can really sort of just understand it with just this picture. Here's your data, here's your existing features, and so if you tilt this and create f1 plus f2 over something, you get this axis and then that axis, right? And you can basically say, hey, the data is completely explained by this one axis and not 2 axes. So it's a dimension reduction technique. It's a way to get rid of data, get rid of variables. But it has all right, so there's clustering methods. This is when you use sort of various ways that things are correlated to one another, and when they deviate from that correlation, you make a mean reversion bet that they're going to come back. And there's various ways to do it. There's a distance method, which is just one security minus the other security, and looking at that resulting signal. A little more sophisticated version of this co-integration approach, where you try to find two or more securities that when you combine them at certain levels, the resulting price series is stationary, because prices, random walk, they're not stationary. They have a very high autocorrelation, which breaks a lot of models. But if so usually use returns, today's price over yesterday's price minus 1. And then hierarchical principal component analysis and k-means clustering. There's some good papers on this. Autoencoders. So this is a unsupervised learning technique, which is useful in sort of neural networks. You can think of it as principal components, but with nonlinear axes. Right, so if I gave this data plot here to principal components, it wouldn't be able to tell me anything. It would just say, there's some axis here and there, and it doesn't really explain the data better. But an autoencoder can actually learn the circle as an axis and the distance from the circle as a second axis. So you sort of get polar coordinates out of that. And it's a very interesting idea because, oh, sorry, I should have explained how they actually work. This is the input data, and you basically force it to be squeezed down, and then you try to get out the input data you started with. So you're forcing the model to represent all of these inputs with two numbers. So you're compressing the information, which means those two variables have to sort of explain the data, and that finds structure in the data that you can then take and use in a supervised learning technique with this thing. So, and it helps you put a little noise in the input, although the output should be the unnoised versions. So if there is noise in the data, it learns to sort of ignore the random noise and get back the actual sort of data. So yeah, use it for supervised learning. You can initiate models to create the model that has parameters in a favorable region of the parameter space, clamp them or not. Reinforcement learning, this has been very popular lately. It's won a bunch of video games. It's not particularly, I think, suited for trading because there's no, you shouldn't be affecting your environment. Reinforcement learning is about agent taking an action and then that changing the state he's in, and then sort of finding the optimal actions that change the states in some manner. So you're not changing the states, hopefully. If you are, you're sort of losing money on slippage. There's no series of actions. You don't need to like go to the right, jump up, press A, come back down. But I think one interesting thing that might make it useful is a recent DeepMind paper where instead of targeting the average reward, you look at the distribution of rewards, which I think could be useful in financial data from a standpoint of just capturing the information better. And there's also this multi-agent reinforcement learning, which is some theoretical construct where you try to create agents that together behave like the market. So long short-term models. So this is a type of recurrent neural network, which means you have the same model acting at every point in time that takes the previous, well, it can take the future too in some situations. And it has a memory component that it can sort of remember past actions. So these are all used in all the language models, all the sort of speech recognition, translations. There's all these generative models that allow you to sort of feed it Shakespeare and get out something that kind of sounds like Shakespeare. And it's so people have been using that for sentiment analysis, like using social media, using news headlines, and trying to be able, for the computer to be able to read all these things and get a sense of people, how they're feeling. If people are happy, they're probably spending more money. If they feel confident, they're going to spend more money. And you get to react to news. And then there's just using it as a price series model, which is definitely sort of made for time series. But it doesn't do very well with noisy data nor changing dynamics. So there are some methods. You can use a pre-trained stacked autoencoders to sort of reduce the dimensionality and reduce the noise. There's also something called the wavelet transform, which is kind of like a Fourier transform, where with Fourier transforms, you take a time series and you break it down into frequencies and how much power is in each frequency. This is kind of like that, but it's a rolling version of it. So you actually get out a time series of frequencies, and you can use this to sort of denoise your data. Risk allocation. So your goal in this situation is to maximize your Sharpe ratio. So you have the weights of your security times the returns minus some penalty term and the absolute value difference in the weights. This is supposed to represent trading, slippage, penalties. You can also just use it to make the model trade less, which can be useful if you want to have longer holding periods. And you divide it by the weights times the covariance matrix times the weights again to get the variance of the model, right? So this is a quadratic programming problem. There's lots of good sort of programs out there to sort of solve this. One major problem with this approach is that if the optimizer can find a linear combination of securities which has very little risk in it, then it's going to try to put all the risk into that component, right? It's found this riskless asset, and so it's going to love it, and it's going to try to put all the money into these riskless assets. Well, those are just the smallest eigenvalues, and they're probably just noise. So you will definitely, the out of sample results will almost certainly be more risky than your in sample results in this scenario. And so what do? You can clean it. I really like random matrix theory. I think it's just an interesting idea. And the idea is hey, if I gave you a bunch of random data, what would you expect the correlation matrix to look like, right? And so, if you have that scenario, you can sort of define how the eigenvalues and the sort of characteristics of the correlation matrix that you would expect from random data, then you can sort of create a threshold to throw out noisy sort of correlations. And it turns out there's a very nice sort of distribution. This is if you assume no sort of factors in the model, but in markets there's generally a market factor. So you give it this formula is more useful for markets because you do believe strongly there's a market sort of one driving factor at least going on. So it sort of takes care of that. And then you use that, so you get the maximum random eigenvalue that you expect. And you look at the correlation matrix, and any eigenvalue below that, you say, okay, that's probably noise, and you raise it. You raise it up to usually the random number. So you've taken all these riskless assets that it found, and you're making it more realistic about their risk levels. And this helps a lot with the optimization. So you find the eigenvectors, use the random max, and then you rotate it back to the original correlation matrix, multiply it by standard deviations, you get a covariance matrix. And there's, I said, basic risk management, which you sort of do at the end. So regime shifts. As I was saying, dynamics change quickly in the financial markets. And something interesting that I happened upon was analogy weighting. And it was this guy, James Savage. It was his master thesis. And he gave a talk in New York, and I happened to go to it, and I really like it. So you train a random forest. So a random forest is a collection or an ensemble of binary trees. Each binary tree is splitting the data up into similar data. So you start with all the data points, and you use the independent variables to split it to two children. And each of those children should have the dependent variable you care about should have less sort of volatility within each group, right? You have split it into two groups that are more like each other in regards to the dependent variable. And you keep doing that until you can't decrease the risk, the risk anymore, volatility, or you hit a minimum size, right? And so you get all these random forests. So you do this many times, hundreds of times sometimes. And then so you can take from that you can get what's called the proximity matrix, which is how often do these two data points end up at the same leaf at the bottom? What percentage of the time, right? And it's a very sort of elegant distance measure for these data points, and with only a couple parameters, how many trees and minimum leaf size, which are pretty well sort of there's some rules out there. And so so it's useful. You can emphasize the correct history, right? You can look at historical data and say, okay, this is most like the years 1997 through 2001, right? And you can use that to train your model. But you can also use it for risk management. And this is interesting idea. It's a sort of a natural way to de-risk. When you assume your a priori belief of the correlation matrix is that it's all a bunch of ones, which is saying there's no diversification benefit whatsoever in the market. So that's going to naturally decrease the positions in your portfolio because you're no longer getting the benefits of diversification, right? So you start that as your prior belief, and you only deviate from that if you find enough data that's relevant. Right, so you hit a period that has no precedent, it doesn't look like anything. Your correlation matrix goes to 1, your weights drop, and it's sort of a natural sort of way to de-risk in that situation. Analogy weighting by James Savage. So this is in the paper as well. So you look at this as, in 2010, what periods were relevant, right? So you can see, it's kind of interesting, this is 2008. So it went from pre-2008, you had all these sort of points that had some weight to it, and then 2008 happened, and you had almost nothing. There was very little history that looked like 2008. And you can look at by summing the total weight and look at that, and you can see 2008, 2009, it goes very low. So you would have naturally de-risked in that scenario.
How does the strategy that you were doing before neural networks compare to your new machine learning powered strategies?
Well, the earlier strategies were focused on only physical commodities, and actually I trade calendar spreads of physical commodities. So I buy crude and sell. I buy November crude oil and I sell June crude oil. So it's a very sort of small esoteric market, which is why I'm able to sort of exist there and such for like 4.5 years of trading, because like most people just don't care about it. It's just not, it's a weird market. So the new strategy is more broad. It will trade various types of futures, not just commodities. I mean, the main thing is that I have actual historical data, so like I have more confidence. And because I can also explain exactly why it's, more or less why it's working, the old strategies is taking advantage of commodity index investors and how they roll their positions month to month. And so, so it's I mean, the back tests for the new model are promising. I would like to get them a little better before I actually start trading it, but I'm getting close, I think. So yeah, like that, I guess.
But you won't share any numbers of the performance compared?
I haven't started trading the new model. Yeah. So.
It's like a related question. What percentage of the models that you tried do you end up trading on?
We need like scientific notation to describe this number. You fail a lot. Almost, I would say 95% of your ideas don't work. There's just too many smart people out there trying to do it. And so, yeah, it can be frustrating at times because you spend like some period of time with an idea that you think is really cool and like makes a lot of sense, and then it doesn't work. And you're like, well, crap, like what am I gonna do now? So like, all right, think of another idea. And it's constantly doing that. It's constantly thinking of new ideas and trying to try them out and seeing how they do. Most of them fail.
Is that failing in back testing?
Yeah, back testing, okay. Yeah. I've never deployed a strategy that lost money so far.
Yeah, you were talking about how when a strategy becomes successful, more money comes into it. Mm-hmm. I guess I was wondering two things about that. One is like, how do you sort of go about like monitoring and trying to like make sure that like figure out when that's happening versus the strategy is failing for other reasons, and like over what time scale does that sort of thing typically tend to happen?
Okay, so I mean, there's sort of general sort of like news going on. If you know a particular like new hedge fund that's been growing, like after the 2008 crisis, everyone realized that HFT firms had done amazingly well. Through it, and so you can look at for that situation with HFT, like you could look at how much extremely fast trading is going on in the market, like the signature of sort of that model, right? I'd say like the time scale would be like on a year or two, like sort of years, Like it takes a while for, it starts to work. It takes a while for investors to come around to it. Then money flows into it. It takes a while to get saturated and then goes away. And some of these things, they die for several years, before they come back, if ever.
You talked a lot about how the data ends up being really buggy. Do you find that you actually get good success in trying to clean data, or like the gold chart you showed where it's like just correlated to interest rates? Like, can you actually go in and then like try to like clean that data up or modify the data? Is that successful, or is that just like?
No, that's what you do. It's what you do. And I had to cut sort of some slides about like a technique you can use for it. But you can use adaptive boosting, which is horrible for outliers. And you do a little math jujitsu, and you actually use it to detect outliers. And then you can know sort of things that you need to look into if there's like crazy data. But like I say, so you try to clean the data, you probably don't succeed. And so that's why I like the a loss function, the quasi-Huber loss function that de-emphasizes large errors because of that.
You talked about how...
You got notes, man. I don't know.
This is a question. Neural networks were pretty good, and you actually got because you used nonlinearities there. To what extent is the data nonlinear? Like if you do, if you basically break it up into your polynomial functions, what order do you get for your data? So what type of nonlinearities would you use?
I've never actually tried to measure it. I think conceptually you can make a good argument for nonlinearity because there are so many feedback loops, and any system that has sort of positive feedback loops and negative feedback loops is going to create nonlinearity. So I think I haven't actually went and measured it, but I think conceptually there's a good reason to believe it's true.
It's kind of a general high-level question. I saw this article today about how Warren Buffett made a bet 10 years ago. Yeah, so he's apparently ahead. And the point is not even that he's winning the bet, that he would outperform.
Fund of funds will underperform the S&P for a 10-year period. This one particular fund of funds, which is one of the better known fund of funds, made the bet with him. They would do better over a 10-year period than the S&P did. That didn't happen so far.
Right.
There was this 2008 crisis you might have heard about.
So would you attribute it to the 2008 crisis, or what are your thoughts on that in general is my question.
Yeah, I'd say in general it kind of misses the mark a little bit. Like when I was talking earlier about your returns being a part of a larger portfolio, investors actually don't need you to beat the market. They need you to be uncorrelated and have positive performance. Right, so you're just, you can't diversify away the equity exposure, right? You just have more equity, you get more risk. So if you think of yourself as a small portion, 1 or 2% position in this portfolio, you actually don't have to beat the S&P. And the stuff I do is market neutral, has zero correlation to pretty much anything. You can never tell how I'm doing. And it's because of that, I don't compare myself to an index. I don't try to beat an index. I don't try to sort of compare that way because if say you compare me to the commodity market in general, and the commodity market does well, then you made a poor decision to invest. You should have been all commodities if you'd known that. The point is you're a separate portion. And a lot of hedge funds, put majority of their capital into the same thing. I think a lot of hedge funds think of themselves as finished products, but institutional investors don't.
So are you saying that if you're investing a very small amount of money, then your gains returns could be much higher?
Because of the fact that returns are linear and risk is square root, right? So as that thing earlier, where as long as the subcomponent Sharpe ratio or the total Sharpe ratio is greater than the correlation, then a marginal increase is going to increase the Sharpe ratio of the overall portfolio.
So what is a small amount of money? How do you, what's?
It's, it's a delta. It's sort of calculus, and it's, you sort of do it iteratively. If you optimize it using a covariance matrix, you are effectively iteratively doing that, putting the money toward these lower correlation things. But yeah, it's just sort of an idea of formula. It's marginal increase of risk.
So do you have a general idea of how machine learning hedge funds have performed compared to just regular good old-fashioned hedge funds?
It's hard to say because hedge funds are incredibly secretive. I'd say the more common usage for machine learning is sort of clustering techniques. Those type of machine learning, k-means clustering, hierarchical principal component analysis. I know there are some very large quant funds which spend a lot of effort getting unique data, and then they can do cluster analysis with that data, and then figure out what should be correlated to one another and what and use that to trade. I'd say that's a more common approach. I've yet to hear anyone doing a neural network, but then again, like no one would tell you. So, except me apparently, I tell you.
So this one's a little esoteric, but you mentioned the DeepMind paper on distributions of rewards in reinforcement learning, being able to model that, and how that could potentially be applicable to quantitative trading. Could you unpack that just a little bit? I'm super curious.
Yeah, I mean, I think the sort of main point, and I haven't played with this at all, I don't know if it's true or not, but the main point is that you're efficiently using data, right? If you can use the entire distribution, then you are using every single data point sort of in that distribution. Rather than if you just use the mean, you just have one data point coming out of it, right? So there should be more information in the distribution in that scenario. And also, it mimics real life. If the distribution is heavily skewed negative, the median or mean might be great, but there's this massive negative sort of risk there. Then the distributional learning will sort of learn that and sort of learn to avoid those situations.
So just a very general question.
All right.
You talked about the spidey instincts of your colleague with the egg picture.
Oh, sorry?
The egg picture, the eggs pattern.
Oh.
The egg chart.
Oh, yeah, sorry.
Right,
yeah,
sorry,
yeah,
egg
sorry.
chart, right. And I'm just thinking that's very instinctual, intuition, that type of knowledge. Do you think we'll capture it adequately? That's your foundational belief, right? But
I mean,
do you see some limits?
that is a foundational belief. It's hard to say because, like I say, because it is such a complicated process, and most good traders can't actually explain to you why they want to do things. They just sort of have looked at so many historical periods, and they've just learned how to do it in that manner. So, yeah. I don't know if that answers your question.
I've kept it open-ended just to see if you saw some foreseeable limits and how much you'd be able to replace that art form.
Yeah.
Yeah.
Yeah. I mean, it should capture some of it, but I think it'd be difficult to capture all of it. There's just too many factors going in to these. It's interesting. You take a person who's been successful, in, a large hedge fund, you put them in on by themselves. And a lot of times these guys fail because they didn't realize it, but they were taking advantage of all this information that they had at this large hedge fund and talking to their coworkers and things like that. There's all this things that influence your decisions that you don't quite understand.
So you mentioned LSTMs for language and sentiment analysis.
Mm-hmm.
I'm wondering what types of signals you derive from that?
Yeah, so I mean, something you can do is sort of general economic sort of moods, which would allow you to sort of make general sort of equity bets. I mean, if you know how the economy is doing, there are a lot of ways to play that. I mean, it is sort of several steps and removed, but especially sort of in the period of sort of the Fed being so active, good historical data, gold goes down, crude goes up. And vice versa. Or other way around, sorry. Good data means less quantitative easing, gold goes down, crude goes up because of economic activity. So, I mean, it's things like that. And you can use maybe for retail investors, maybe you're counting how many times people mention a company. There are these two guys at Citibank who were using the credit card database to trade off of, which is completely illegal. But they crushed it. They absolutely they crushed it with predicting earnings by using the credit card data. And then they got caught and it didn't go so well.